Welcome back to A Bite from the Money Sandwich, where we provide practical and easy to understand tips and ideas on how to manage your money better, so as to let you retire with comfort and on your own terms. Ever wondered how to get the best deal on your mortgage, bills, and financial products? Today, I'm joined by Sally Tindall, who is a Data Insights Director and Chief Spokesperson at Canstar Australia. Sally, she shares insights from Canstar's 2024 Consumer Pulse report, highlighting how rising economic pressures have led more Australians to use comparison sites to find better financial deals. She explains why reading the fine print is crucial, how negotiating with lenders can save you money, and the best ways to manage personal debt. She also discusses the challenges facing first-time homebuyers, the importance of having a plan B, and how to balance financial goals with enjoying life. Well, welcome, Sally and Canstar, to the show.
Thank you for having me, Mark. It's lovely to be here.
Excellent, excellent. Now, Canstar is a well-known brand. You've actually got your 8th report out this year, the 2024 Consumer Pulse report. And for me, really, the last 10 years, you could see there is such interest in comparison sites. I don't know if it's the economic climate, but why are people, going to comparison sites?
I think part of it is the economic climate, but I think a large part of it is, and I know that people don't feel like it is, but that we are flush with choice when it comes to banking options here in Australia. Yes, the big four banks really dominate the market. They often take over 70% of things like deposits or home loans, but there are a lot of other competitors there in the mix. And I think that's really important in helping drive competitive prices. It puts pressure on players like the big four banks to keep their prices competitive. But also it can make comparing your options incredibly difficult. It can make them incredibly daunting. And that's where comparison sites really start to shine, because they can be your one-stop shop for trying to work out what product might fit with your finances. And so instead of trawling through heaps of websites and trawling through a lot of fine print, you can use a comparison site to put the products you're considering side by side, not just to see things like the interest rate attached, but you can also compare things like fees and features to make the right decision for you. Comparison sites are really helpful because they have filters at the top of them. And so they can help you narrow down your choices within a couple of clicks of the button, but they also have a lot of information on there. So if you're not quite sure of some of the terminology that comes with something complicated like a home loan, you can hopefully find out the answer, understand what you are actually looking for in a home loan, and narrow down your options. So for example, if you were an investor, you don't want to see the owner-occupier loans on offer at this point in time. In fact, it'll be annoying because you'll see these lower rates and you won't be eligible for them.
Very frustrating, yes.
Oh, it's so frustrating, isn't it? And you might also want to rule out any principal and interest loans where you're paying down your debt. You might want only to look at interest-only options. Again, it will help you filter it out. You might have a low deposit. You might have a big deposit. There's all sorts of different filters that you can use on a comparison site to get to the results quickly. The one thing I would say that comparison sites do not do, in my mind, is get you out of reading the fine print. Yes, it can help you narrow down your options. You've got to think about what suits your finances. So take your own personal circumstances, in mind at every time, and potentially go and get some personal financial advice. But at the end of the day, when you land on a financial product, you've got to get that cup of tea, couple of Tim Tams, and read through the fine print. Nothing gets you out of that.
And what's your favourite Tim Tam?
Oh, such a good question. Anything with a lot of chocolate on it. So I would actually just go for a block of chocolate over a Tim Tam. Just get the biscuit out of there.
It's one of the things I really like, because I think, and you've made a few really good points, when especially it's all, when you're going through the websites, there is so much information out there. It's not really knowledge, because it can confuse you more than inform you. Whereas what you do, what I really like, is that it's comparing apples to apples. You've got it all in the one area, and you can then say, okay, you're you can look at it. You've done all the work to sort of compare all these and put them in a line. Whereas, it's amazing the marketing material for every different website, banking website. You go, they all sound great, but it's just having that there. But you're right, and you've also said, at the end of the day, this is a lot of times, especially if you're talking about home loans, a very expensive decision. So getting advice is also a really good option because, you don't want to get trapped by the fine print sometimes.
No, the fine print can really trip you up if you haven't done your homework. And I do think that there's a role for comparison sites and mortgage brokers that does go side by side in this journey.
I agree.
Comparison sites are a fantastic place to start. It might be a good place to end up as well. But getting, access to an opinion from a mortgage broker can really help as well, especially if you're a first home buyer or taking out a kind of tricky home loan that might not be as straightforward as a normal owner-occupier principal and interest loan. To understand your options. There's some limitations when it comes to mortgage brokers that you've got to be aware of. They typically have a set panel of lenders that they can organise your loan with. So you're not looking at the whole market. The whole market can be as many as or over 100 lenders in some cases. So they're only looking at a limited panel. But if you come in informed with knowledge on your side that you've gathered from a comparison site and have an informed conversation with that broker, you are on your way to getting what is hopefully a great home loan for your needs.
Yeah, totally agree. I compare it to prior the global financial crisis of 2008, and a lot of people I used to meet, especially on the investment side, was just blind faith. Yep, this person has my money and he's just going to invest it. I don't know where it is, but it seems to be earning well. It's going along well until the global financial crisis happened, and then all hell broke loose. Since then, to me, there's been that real change. Arming yourself with that knowledge, but you do realize you've got better things to do with your time. So having someone still look after it, but at least you can ask informed questions. You've got the basis and you're just not blind faith that you're putting in with that whatever expert, but you also do realize you've got better things to do with your time than do this yourself. But I totally agree. Being armed with that knowledge makes such a difference.
And it gives you the confidence, right?
Yeah,
so you
absolutely.
don't lie in bed at night wondering if you got that right or wrong. You go, no, I've got this because I've done my research. I've talked to a couple of people. I've got a variety of views and I've made an informed decision.
Yeah. And talking about mortgages and housing, because I know Canstar does a lot more than that, but your Consumer Pulse report did highlight that. And we've had COVID. Since then, we've had the rise in cost of living. We've had interest rates go up, rent go up, mortgage rates go up. So it doesn't surprise me that your report highlights that fewer than 1/3 of Australians feel optimistic about their finances in 2025. So with housing costs being one of the top concerns. So what's your thoughts on that? Maybe have you seen some practical tips or ideas to help around that? Or just what's your view on that situation we're in at the moment?
Well, for starters, who would have thought that, for some people, not everyone, but for some people, the last 3 years have been a lot tougher than COVID.
Exactly.
COVID was such a shock. But for a lot of people, it was a wake-up call that they needed to get their finances in the best shape possible. And so during COVID, we saw some astonishing things. We saw credit card debt drop off a cliff. We saw people out there haggling with their lenders in terms of, getting the sharpest deals. And then since then, we've had, the cost of living crisis and, interest rate rises. And we've seen the most incredible number of people moving to refinance as well, or at least haggle with their home loans. So yes, the last, we're going to say 5 years has been incredibly tough. But it has made us more resilient as a result. And our focus on personal finance is, I think, sharper than it's ever been, at least for many families across the country. Now, just to indicate how tough it's been for the average borrower, I'm talking about an owner-occupier. They might have had a $600,000 loan at the start of the rate hikes. They were on an average rate of, say, from the RBA, it was 2.86. Remember those days? 2.86 was the average owner-occupier variable rate. Yeah. Say they've got 25 years remaining at that point. And since the rate hikes, they have not been able to renegotiate their mortgage. they would likely be on a rate of 7.11%. 7.11. It's incredible. So on that $600,000 loan, they would have seen their minimum monthly repayments increase by $1,448. That's not a one-off expense. That's every single month. No wonder borrowers are hurting. But there is a way to get relief in your home loan as a owner occupier, and that is to refinance. Typically, banks reserve their sharpest rates for new customers. It's important to remember that. But also, if you're not able to refinance, and there's a lot of reasons why you might not be able to refinance, or if you decide it's not financially viable for you, there is nothing stopping you from picking up the phone and haggling with your lender, provided you're on a variable rate. And if you're on a fixed rate, well, you're probably laughing all the way to the bank every single month because you're probably fixed with a rate that starts with a 2, and you're smarter than all of us. So, refinancing or haggling will give you an immense amount of relief. And to give people an idea, and I'm talking, so we're chatting in kind of early-ish February. We're looking forward to the RBA meeting that's coming next Tuesday, and hopefully the Reserve Bank will issue a rate cut. So these rates are pre-cut, fingers crossed. But to give people an understanding of what a reasonable rate looks like, complacent owner-occupier is on 711. The average owner-occupier on a variable rate right now is on a rate of 6.33%. That means, on average, people have actually haggled or refinanced their way out of 3 standard RBA rate hikes. It's fantastic. But 6.33, that's the number you keep in your mind. Are you above or below that? And if you're above that, you need to ask yourself why. But even to go under 6.33, that's average. You want to be well below that. And to give you another indication of just how much, competition is in the market still, there are 38 different lenders on our website that are offering at least one variable rate to owner occupiers under 6%. 38.
Okay. 38.
Now, a Big Four bank is not in there, but you'll find that subsidiaries of biggish banks are in there. So CBA's Unloan is in that group. Bendigo Bank has a loan called Timely Home Loans. They're in that list. There are loans in there that offer offset accounts. There are loans in there that offer small deposits. There's a lot of choice in there if you really know how to look. Again, back to using a comparison site to get the filters right for you and see if there's a rate under 6%. Now, if you're an investor right now, there's only 3 lenders that are offering at least one variable rate under 6%. So slim pickings for investors for a rate that starts with a 5. But once those rate cuts hopefully start flowing through, we'll see variable rates really, firm up in the 5s, potentially even go into the 4s. Depends on how many rate cuts we get.
Well, yeah, fingers crossed, but I think 2025 is at least going to see some relief with interest rates, or that's what we're feeling. But just, I think it's really important what you said, because so many people I've met over 30 years always said to me, well, no, I'm loyal to my bank. They'll be loyal to me. And I'm just saying, no, they're not. They're loyal to their shareholders. They're not loyal to their lenders or who they're lending to. So really, just because you've been there with 30 years, someone coming in as a someone new coming in to get a loan from that bank is going to get a better rate than you, who've been there how many years you have. So you absolutely, if you can't move, then you do need to call them up. It's absolutely a great, great tip. But it's also why I do think of mortgage brokers who can build a relationship with you and that you can see on a regular basis. Well, there's always something. Yeah, if there's a better loan out there that's going to save you money, well, why pay money if you don't have to? It makes perfect sense.
You should not be paying for loyalty, whether that's to your bank or to your mortgage broker or whoever it might be. This is your finances, and you need to put yourself number one. I think that is first and foremost. But you can play hardball with them. The beauty about mortgages is that there's still a lot of competition in the market. It's not quite like what we saw in 2022, 2023, where the banks were fighting tooth and nail for your business. Yeah. They were swashing around thousands of dollars of cold, hard cash in order for you to refinance. There's some cashback offers still around, but there's not many. I think there's around 10 or so. But there is still some level of competition in the market, and we see this in a lot of different data sets. So again, back to that rate, that average existing customer owner-occupier variable rate is 6.33%. Well, this is the RBA records that I'm reciting here. The average new customer owner-occupier variable rate is 6.24%. Yeah. And it's not a huge difference, but that tells you that new customers typically get better deals than existing ones. If you're going to refinance, I should say it's really important to factor in switch costs. So it can cost a little bit of money. You know, there's a discharge fee from your old bank. I don't think your old bank, if you're ditching them, is going to get you out of that one. It's about $350. There's usually some state government fees around $300 mark, but it can vary from state to state. And then there's upfront fees from your new bank. But if your new bank wants your business, play hardball with them. Those fees are negotiable.
Yeah. And really, just even as you said before, a 600,000 loan, you're saying between the average to the high was over 1%. Well, 1% on 600,000 is $6,000. So, you know, if that's the sort of fee you can save on a yearly basis, well, you don't mind paying $300 odd to that. But it's just so important to know. And people just don't know what they don't know. So it's great that, you know, someone like your comparisons, or Canstar, can provide that information at the fingertips. If we move from sort of mortgages or home debt to personal debt, because that's something that really concerns me. I've got daughters, and I just see that really once you get a job, access to easy debt through credit cards, buy now, pay later, it really is a problem. And, you know, I think your report says it's up to about 15,000 on average personal debt, not just for young people, across the board. That's a problem.
It's a huge problem. A lot of that is young people, unfortunately, because they've got these giant student debts in the background.
Yeah, student debts. Yeah, that's another big issue. Yeah,
really difficult conundrum, because investing in education is really important, obviously. But when, you know, what we hear is that when people come out of university, they've got a decent job, it's time for them to hopefully buy their first home. That HECS debt or help debt is really eating into how much that they can borrow. It's really difficult for young people. And yes, that gets moved in line with indexation or CPI, or the government's changed the rules around it recently. But, you know, it's nothing like credit card debt. And so that, as you said, Mark, is the most toxic of them all, because their interest rates are incredibly high. And so I'm going to ask you a pop quiz. What is, the RBA records this, hopefully you don't know the answer because it'll add to the drama, but what is, do you think, the average credit card debt for someone that's paying interest on their card?
Or how much they have in debt, or what's the interest rate?
No, what's the interest rate they're paying?
Oh, most credit cards are over 20%.
Well, the average is actually lower than that. It's 18.59%, but that's still an incredible amount to be selling out.
It's 3 times what the average home loan is. Yeah, it's on average. Yeah,
it's ridiculous.
It's ridiculous.
There is plenty over the 20% mark as well. In fact, all 4 big banks, their rewards cards, they're all over 20%. I think they're 20.99%, but there's some that climb over 25%, if you can believe that. It's incredible. So it's really important to understand when you're taking out that first credit card, just what you're signing up to, what the interest rate looks like. Really importantly, how much money you can borrow on that card. So what's your limit? Because a lot of those fancy cards will have a minimum credit limit of, say, $15,000. They, you know, as a young person, you probably wouldn't be eligible for that card because your income isn't high enough for them to service the debt, for the bank to give you the green light to actually get access to that kind of money. But really have a look at what your maximum credit card limit is before you're signing up to the card, and do the maths to make sure that you can pay that off if you get into a bit of strife. It's also so complicated, and credit cards are sometimes complicated, I think purposely so for some people, to understand how interest-free days work, because you typically get up to 45 or 55 interest-free days. The most popular period is 55, but you'll notice when you get to the fine print, it says up to 55 days. And that's because it will really depend on where you are in your billing cycle and when you make the purchase as to how many interest-free days you have. And you can have as little as 30 interest-free days and as many as 55. the rule of thumb there is as soon as the bill lands in your inbox or as soon as it lands in your letterbox, I don't think it lands in anyone's letterboxes these days, but pay it in full as soon as you can.
We do through our own courses and through the book, The Money Sandwich, we just say, really, it's not the actual credit card limit that they give you, it's the actual limit you need to set on yourself, as in because we do know absolutely, number one, pay it all off if you can. Unfortunately, for a lot of people, they can't, but you should never borrow more than what you can afford to pay back within 10 months, because that will pretty well get rid of all the interest. And so if you can afford to pay back $200 a month, then you can not spend more than $2,000, because at least you've got the savings to pay that off within 10 months. But you really shouldn't, unless you've got $2,000, shouldn't do it in the first place. But that's life. We do know people just get credit cards. Yeah.
I think the problem there is that some people have a rubber arm and they might put something big on their card and chip away at that debt, but then add another purchase onto the card and then another one and then another one. And then they've always got $2,000 that they're owing on their credit card and they're always paying interest to their bank. If you can stop the cycle in its track, you can get off the debt treadmill. It's really difficult to do, but there are some steps you can take in order to cut that cycle. I would say for anyone that's got any kind of credit card debt where they're paying interest, have a look at your interest rate and see if you can get it lower. You can do that potentially by picking up the phone to your bank and haggling for a sharper rate. You never know. They might be in the mood to negotiate with you, or you can move that debt onto a lower rate card. Sometimes that's risky because you would hate to keep the two cards open, so put a priority on shutting down the first card and transferring it over. The last thing you want is to be getting access to double the credit and paying 2 annual fees and things like that. But then, as I said before, making a plan to stop the spending. You've got to stop it in the tracks and put the card in the freezer. You can take the scissors to it if you need to. Take it off your phone because you remove the temptation to add to the problem, and then you sit down and make a plan to pay that back. And I like to say, take half a day off work, spend that half a day renegotiating all your biggest bills. So that could be your mortgage if you've got one. That could be your electricity bill, your gas bill, your internet, your phone. Try and renegotiate every single one of your recurring bills that's negotiable. Work out how much you're going to save from that half a day exercise, and then set up an automatic transfer into your credit card and chip away at the debt that way. That way you'll have sharpened up your finances across the board, but also hopefully pay your credit card debt off in a priority. The other thing I would suggest is, and this is obviously general advice, not personal financial advice, is it's worth considering a personal loan, particularly for someone that has a rubber arm, that feels that they can't trust themselves with the credit card, with the temptation. Personal loan is quite good for anyone that has trouble with persistent credit card debt, because you can transfer it over to a personal loan. Often your interest rate that you're paying will depend on your credit score, so understand what a competitive rate looks like there. But what I love about a personal loan in these circumstances is that it forces you to pay off your debt in full, in set time frame, in equal chunks, without the temptation to add to it. And I think for a lot of people that helps them get off that debt treadmill.
Yeah, and for a lot of people who are just paying the minimum, that could be 30, 40 years before they pay that. Whereas with a personal loan, it could be 3 years, 5 years, but at least it's, as you said, a set period of time. So no, that's
at least it
good.
gets done. And you might want to fix that rate. It might be variable, but you at least know exactly how much you're shelling out to that lender in terms of interest rates and fees and things like that. And hopefully that will serve as a great reminder not to do it again.
Exactly. But also, one of the things I really liked about what you said is, so many people say, yeah, one day I'll get to it. You're just saying, absolutely, just take a half a day and just do it. Put it in your diary and just do it. And I just think that's a great suggestion. Actually, I think that more people should do that.
To add to that advice then, how about you take a half day or even take a full day, so you can do all the negotiating in the first half of the day and take yourself to the beach in the second as a reward, or wherever you might be.
Yep.
But also, before you leave work the day before, tell everyone about it. Tell your boss what you're doing, tell your colleagues what you're doing, because when you come back into work after your day off, they're going to ask you how you went, and you'll feel that you're then accountable for it.
Yeah, and I talk a lot about being held accountable. You know, if you are being held accountable, you just do it. Yeah, it's
Yes.
human nature. If you're not held accountable, yeah, you may slip off, but if you're held accountable, you'll absolutely do it. So no, I like that. It'll be interesting, the conversations the next day you're back at work actually on that. One thing I really like, because we're talking negatives, you know, the debt side of it all this, but one of the things I really found about the report that was a real positive was that travel has overtaken cost of living as the Australians' number one goal, it seemed from your report. Saving for a holiday. Well, that's definitely positive and upbeat. So I like that.
I love it. I think that we all need to recognize that we're humans and that we can't act like robots the whole time with, just being perfect with our finances 24/7, 365 days a year. You need to have goals. And some of them can be enjoyable goals. Having a goal of saving for a first home is a fantastic one to have, but give yourself a couple of breaks there in between, because you might find that if you've got these short-term goals, such as a holiday, it will make you, just engaged more, knowing that you've got a lovely holiday on a lounge chair by a pool with a cocktail in hand to break up the monotony of saving and keeping your finances, in the best shape possible. These small treats that are really important in the saving process. That could be extended or to something as simple as, anyone doing up a budget, a monthly budget, a weekly budget, whatever it is, set yourself a target for that week or month. And if you go under budget, then treat yourself and set yourself a little goal there. You know what I mean? Because treating yourself will avoid blowouts as well.
Yeah, and I think we were talking about COVID, and since that was 5 years ago, but we really experienced a period of mental health, and we needed to help our mental well-being. And then really the last 4 years have been financial well-being, the stress around increased cost of living and mortgages and rent. I just think, you do need to have, for your financial and mental well-being, these little goals, these little trips. They don't have to be expensive. They just got to have something to look forward to. I think it's just so important.
Oh, it sure is. It just helps people stay focused, stay positive. And we've got to remind ourselves that life is for living. You know what I mean? Yes, you've got to keep an eye on your finances and make sure that you've done your homework, but you've also got to be enjoying yourself. Otherwise, what's the point?
Yeah. One of the things you did just say then was saving for a deposit, because it is still one of the, the Australian thing. Buy the great Australian home, the quarter acre block when I was growing up, but it's still probably, for a major goal, is still probably the number one. And we see a lot of people renting. Renting's going up. People are experiencing the problems there. What's your view on the whole renting or saving for buying a property on that side of it?
Oh, it's incredibly tough. My goodness, first home buyers are really, they've got to, it's like climbing Everest and then another Everest on top of it. So first home buyers looking for a way into the market would have been just astonished at the last couple of years, because they are looking at rising rents, rising interest rates, and rising property prices. I don't think any of us thought that the three would come as a triple whammy for first home buyers. And still, despite this, we're still seeing, 10,000 first home buyers a year or thereabouts make it onto the property ladder. Those numbers aren't like they were. The recent peak, I think, was in COVID, just before all the investors flooded back in. So December 2020 was kind of the recent peak for first home buyers. The numbers have petered off since, but there's still 10,000 people getting onto the property ladder. But if that's not you, and that's, a really important goal for you, it could be time to go back to the drawing board and come up with a plan B if plan A isn't working. And that might be readjusting what you're looking for in terms of the size of the property. So, don't go out looking for a 3-bedroom family home with a patch of grass and a pool first off. Obviously, you're not going to get that. But, readjusting it, it might be, instead of looking for a 3-bedroom apartment, you're looking for a 1-bedroom apartment. You might be looking, for something, quite established that you don't have to do much with. Well, see, maybe you can get a renovator's delight in there, or moving further away from family or friends as an option. I know it's a really tough option, but they do call the property ladder a ladder for a reason. You're not meant to jump onto it in the highest rung. You're meant to climb up. And so getting your foot in the door will give you, a foothold in that property market, but it'll also give you the confidence and knowledge to know how to climb up it. The other strategy that is really surprising, especially when you look at the numbers, is that people don't look at it and consider it, is becoming an investor first up. There's the vast majority of first home buyers, according to the ABS statistics, are actually owner occupiers. There's only a very small cohort that come onto the property ladder as investors, but it's not a bad option to consider, but you've got to understand the pros and cons before you do. Obviously, there are definitely tax implications of being an investor rather than living in the home. I think a lot of people are deterred by the fact that suddenly as a first-time buyer, they're not eligible for certain grants and concessions. Yep. That can really rule it out for some people. But do the numbers yourself and understand, make an informed decision about whether this might suit, your long-term strategy and your short-term strategy, but also your long-term strategy. So as a rent investor, you might have the luxury of renting for a low cost at your parents' house and then buying a property, maybe even in your area, that's someone that you get a tenant for. And then, eventually you have a goal to move in there yourself. That could be one option. It might be buying in a completely different state and renting it out permanently, as an investor. And never actually planning to live in the property. It's really important to do the numbers. You'll find that, if you've got someone helping you pay the mortgage as a tenant, that the amount you can borrow from the bank increases typically significantly, particularly if you're living at home. But again, go and do the maths. Have a chat to a couple of banks. Understand what your options are. Understand the pros and the cons of being an investor and make an informed decision.
Yeah, and I think you were talking about having a plan B, and I just think that's it. I do love property. I think everyone should have the ability to afford their own property, but it doesn't have to be your home. I think people do need to, getting on that property ladder, exactly as you said, starting at the bottom, is just getting on. It's just getting on because, if you had to try and save up or hope that there's going to be a big dip in the market or you wait for the market, no. Property just historically has just gone up over the long term, and just being in there is just there. And I like that rent fest. I must admit, I've come around, especially the last 7 or 8 years, because I think it's, especially since COVID and mental health and mental well-being, you want to be around community, you want to be around family and friends, close to work. And I think when we used to say, well, I can afford being a place that's an hour out of the city, but I'm away from my family, away from my friends, I'm away from my work. That's from a mental health point of view, you do need to take all this in consideration. It's not just a financial decision. So I think buying property where you can afford, whether that's an investment or it is a home, and I think the major cities, it's just becoming far more of a struggle. But having that plan B, I think property is still a good idea, but you just need to think differently about it.
Especially for those people that, might have parents that, can't help them out, unfortunately, with a cash gift to go towards their deposit. They might not own property themselves, so they can't go a guarantor on the loan. So then you end up having to pay lender's mortgage insurance if you've got a small deposit. But they might be able to provide you with a roof over your head. And sometimes it's entirely painful living with your parents. But if it's for a short period of time, perhaps you can make the most of it, because renting at this point is so astronomically difficult as well. Rents have gone through the roof, particularly in hotspots where the vacancy rates are so low. On the back of rising rates, I understand investors are trying to recoup some of the costs that they've had to pay because of the higher interest rate environment. But I don't know that there's many renters out there that think their landlord is going to start dropping their rent when interest rates start falling. So, it's a really incredibly tight position for renters due to a lack of stock. That problem isn't going away anytime soon. It's
not going away anytime soon. Yeah, not when we take migrations back in full blast now again, and people going in between states, and especially we're both from Sydney. Sydney just keeps on growing, So it's always going to be tough for rent. And I was passing a place the other day. It was like 30 people in a queue outside to go look at this place, and I'm just thinking how tough it would be for renters. So we do need to think differently about property, but it's not don't give up on it. Just think differently.
Well, you turn the tables, and
Yeah.
instead of being the tenant, you become the landlord.
Absolutely, totally agree. We've taken a lot of your time, Sally. This has been brilliant. There's lots of other things that I would have liked to have discussed with you. So maybe we can come back. You come back again. But one of the things we're going to see how the interest rates, and hopefully, fingers crossed, where they will drop later in February. But just some of the things about just taking some time off and looking at what you're paying. You're absolutely right. There's so many savings you could absolutely find if you just take a little bit of time. And I know people say, I'll get to it one day, but just that one day you've just got to do now.
The other thing is it can get quite contagious. And if you can make it a competition between someone else, that might be your partner, that might be a colleague, you're going to be really away. I've got a good friend of mine, and he and his wife have a competition every week. I think they must take it in turns to do the shopping about who can get the lowest cost shopping for that week. And he tells me, and he's got a family of 4, he tells me he's getting it under $100.
Really?
I still don't understand how or what the family's eating. He assures me there's good square meals in there, but what a great idea to make it a competition so that, and once you start saving, you want to then look for the next sugar hit of where else can I save? And so lean into that.
And it's just actually good to having the conversation about money, because so many people don't want to talk about money, or they fear money or how it is. But you can absolutely, once you get on top of it and you get that sense of control back, it's such a good feeling. It's such a good feeling.
Absolutely. But also you get a variety of views. So it's really important not to just talk to one person, because you might go, oh, okay, well, my neighbour's doing this, and they say it's a really great hack. Well, it might be a great hack for them, but it might not be a good hack for you for all sorts of reasons. So getting a variety of advice is so, so critical.
Yeah, great. Well, you've actually, in the last few minutes, given me some great pieces of advice, but it's always one of the questions I do ask is there something that you've been given? It doesn't have to be if you work related, that, a great piece of advice that you've been given that you'd like to share?
So you pre-warned me about this one. So I've done lots of thinking. I've got so much that's swishing around in my head. But one of my previous bosses, who's fantastic, said once, the best time to plant a tree is yesterday, and the next best time is today. So I do have that one at the front of my mind. But many moons ago, I did work for the Prime Minister. It was Australia's first Prime Minister, first female Prime Minister.
I was about to say, 1904.
I'm not that old. I'm old, but not that old. And she said, don't sweat the small stuff. And I love that piece of advice. It can be applied to almost anything, and that includes your finances. If you're going to get joy out of saving 50 cents somewhere, then go for it. But if if you've got limited time and you want to start revamping your finances, go top down, which typically means start with the mortgage and the groceries or the rent. But, you go top down and don't sweat the small stuff.
Yeah, I must be. I was told that a long time ago, and I've loved that. It's one of my favorite pieces of advice. Don't sweat the small stuff. Sally, it's been an absolute pleasure to having you on our show. So thank you very much for your time today.
Thanks for having me, Mark.
I hope you enjoyed this episode. If you'd like to know more about Sally and the 2024 Consumer Pulse Report by Canstar, visit their website, canstar.com.au, and follow the links, or feel free to email me on admin@themoneysandwich.com, or visit our website, themoneysandwich.com, if you have any questions or would like to learn more. Want more practical, easy to understand tips and action lists to help with your money stuff? The latest version of my book, The Money Sandwich, is now available to order on Booktopia and Amazon, as well as available at all popular bookstores. Everyone deserves to retire comfortably and on their own terms. Make this the year you take action. As with every podcast, this information is not advice, as not personalised to your own situation. And past performance is never guaranteed for the future. What we are trying to do here is to provide tips, coaching, and education to help improve your money knowledge, which we believe can only be a good thing. See you next time when we take another bite from the money sandwich.